Hello and good evening, everyone. Welcome to Paytm Money Talk, episode number 12, Long-Term Wealth Creation with Large Cap Mutual Fund. I'm really excited to start this conversation on this very interesting topic today. I'm Neeraj Gugoi, your host, a trader and educator. And this whole talk is powered by Paytm Money. So before I start the talk, let me introduce you about what the talk is all about. Paytm Money Talk is such a platform where we try to share new ideas, new investment strategies, and new way of looking at your investing game. Our endeavor is to consistently create high quality content that can empower and enlighten you on your investment journey. If you're an investor learning and looking forward to invest in mutual fund, this episode is particularly for you. You will have an opportunity to interact with the professionals with decades of rich experience in the market, in the financial market and asset management. Also, in this episode today, we'll interact with fund managers from first AMC in India, that is Unit Trust of India, UTI, and someone with so much of experience and young, I'm excited because we have got young entrepreneurs, educators in the field, who is Aditya and Harsh. They will also be participating in the whole discussions. So let's start. Request our team to start the video, and we can start after that. Now, to discuss this topic today, let's invite Mr. Aditya and Harsh Goela. Both of them are brothers and one passion, that is the stock market. Both of them chartered accountants, CFA, MBA in qualification. And most importantly, they're TED speakers and also they're speakers in Joe's Talk. So they have trained thousands and thousands of people through Bombay Stock Exchange, National Stock Exchange. In fact, the number, they have trained more than 2 lakh people all around the world. In fact, 27 plus countries. That's a mind-blowing number, guys, right? And they have conducted sessions in colleges all across corporates all across India. So welcome both of you, Harsh and Aditya.
Thank you, Neeraj, and thank you so much for that kind introduction. Just a small thing that Aditya is a CFA, I'm an MBA. So
okay, perfect.
Otherwise, I'm very, very excited, sir, to take this conversation.
Really, Neeraj, it's always best to be on your platform.
Yes.
Wonderful. In fact, people who are into the investment, they already know you. They might have attended your training program, right? So as we start, I would like to ask you a few questions about the market. The first part of this show is about the market lens. Now, as you know, today, these days, of course, we are very bullish. Of course, our market is very resilient when we are seeing lots of volatility all around the world, but our markets are still steady, right? You have seen a few days back what happened in Fed raising interest rate. So I'd like to ask you about, what is your take on the current market situation? Geopolitics, inflation, instability all around the world, crude prices, rising interest rate. So what do you think about the investment scene at this point of time?
Personally speaking, Neeraj, मैं तो बहुत optimistic हूँ markets को लेके. Why?
Right.
Because what is my logic behind it? क्योंकि if I look at India from a 10-year perspective, तो सबसे पहली चीज that अभी we are going to get the demographic dividends because we are going to have in our country we are in a situation जहाँ पे the earning population would be higher than the dependent population, and obviously when that is the case तो खर्चा ज़्यादा होगा, people spend more, GDP will increase, the benefit will come to stock market. And factually, if we see that the past 10-year returns of the Indian markets, it has only been around 11.27% only. And we always say कि index to gives a 15% plus or 14% plus CAGR on a longer term basis. So Indian markets मेरे हिसाब से अभी भी there is a lot of scope to grow. हम होता क्या, I think I feel कि हम बस 2020 के मार्च के डिप से देख रहे हैं and we see कि the Indian markets have done so well. But if we see it from a 10-year perspective, there's still a long way to go. And seeing the current geopolitical situation, everything, no, I feel that is even better for India because अब India पूरे hub में आ गया है. And personally speaking, I am तो very bullish on India.
Great. What about you, Aditya?
I think I'm on the same boat, more or less. India's growth story has just started, and you can really see from the market itself. I mean, globally, India is actually performing really well. So I completely agree that India is somewhere that it is. There should be. I mean, you should invest in India, and as Indians, I think that is the first thing we should all do.
Now, what is your advice to new investors? Right, lots of young people. In fact, we have seen in Corona times, unprecedented number of young people. They have entered the market. Probably they don't have so much of experience to take the decisions on their own.
Right.
So people are confused at times, because historically, short, small caps, they're very attractive. Large caps give safety. So what is your suggestion to them? Should they go directly into the equity, invest themselves, choose their stocks, or they should take some kind of, bit safer route, kind of mutual fund? So what do you think about, what's your advice for them?
Neeraj, I feel that it really depends, first of all, if you want to go for large cap, mid cap, or small cap, and depending on the risk. So, we understand that there is a certain risk, and we also understand that new people don't understand that risk specifically.
Right.
So generally what we say is that if you can spend some time in your research to understand the stocks you're picking, to basically just be with the markets a little, tabhi we would recommend to go for small cap, mid cap. Other than that, I would really suggest almost everyone, specifically those people who are starting off, that they should only start with large cap because those are a little less volatile, and you will be able to handle the journey of ups and downs much easier, because in the small caps it is like this. In large cap it's relatively easier, so large cap definitely for a new beginner.
And adding to this itself, I feel when somebody is starting off, no, all the youngsters सबके दिमाग में रहता है कि trading, because I think stock markets बाहर से बड़ा ही glamorous लगता है. But what my advice would be to all is that you should take the benefit of your age, right? Para compounding आपके साथ है. And doing this, I feel, if you are not very aware or you cannot give much time, one of the best ways to go is through a solid mutual fund that invests in large cap, and that is something जिसमें compounding का benefit पूरा actually students को मिल सकता है.
Perfect. In fact, you know what, I have seen people are always excited about trading, making quick
Yeah.
money. Of course, people who have experience, they know that making quick money in the market is so difficult, or almost
Right.
next to, if you can use the word, called impossible. But
You know,
again,
actually, I think the expectations are very bizarre. There are some people who are, मतलब वो ये expect करें कि महीने का 10% तो है ही.
कमा ही
And
लेंगे.
if you do the like they expect a return of 10% a month, and if you do it on a monthly annual basis, it's 120%. So I think there's an expectation gap. Why do you, I'm really interested to know your perspective. Why do you think there's a expectation gap? What people expect and reality में मिलता क्या?
Right. And again, very important concept, because we are going to discuss about large cap, and we have got big stalwart of the industry today to discuss about. And of course, it's a great experience talking to them. They will be coming a little bit later, maybe after a few minutes. But before that, I would like to touch upon a few very important points. One is portfolio approach of investing, asset allocation, diversification. Because when we are young, we are very optimistic. We are very confident that पैसा तो बना ही लेंगे यार, मार्केट में क्या है, what we do, है ना, ट्रेडिंग करके आपको डबल करना है, ट्रिपल करना है. So again, what you would like to say to those kind of investors about the importance of asset allocation, diversification, building a very good portfolio, robust core portfolio? What would you like to say? Both of you can give your views.
I would say that सबसे पहले से there's no fixed rule for this, right? Because
Right.
everyone's needs are very different. Their financial capability, maybe they have a debt on them or they have an income requirement, whatever. तो कोई fixed rule तो हो ही नहीं सकता. सबसे पहली चीज. तो first thing I would say, there's a very simple rule that I think applies to majority of the people. That is 100 minus your age. So if you're 20, so 100 minus 20, 80. So 80% ideally you should keep in equity. And equity, maybe I feel बहुत over diversification can, like, I'll give the example of one of our relatives in 2009. She bought, I think she had invested around 10 lakhs and she bought an entire portfolio, the barrage of diversification. In 2014, which is after 3 4 years, her return was actually lesser than the index because I think it was
Mhm.
too much of diversification. So ideally, majority should be definitely be in the index, and then one can, मेरे हिसाब से, if what I would prefer is that one can go up to five sectors and one can divide their portfolio there. This is what I would prefer.
Right, right. And in fact, as such, asset allocation is the major thing I feel to getting the return. I mean, if you can nail the asset allocation properly at your certain age, I think 70% of the battle is already done. Because let's say if you buy two different shares, but I mean that stock selection is not such a big criteria to get a return. Asset allocation is much, much, much bigger. If you get this right, so most of the things are right. So as Harsh said, I think 100 minus age is like a decent thumb rule which a beginner can follow.
Wonderful. Again, coming back to mutual fund, काफी लोग ये मिस्टेक करते हैं कि when we choose a mutual fund, हम लोग उसका past return देखते हैं. अगर
Yeah.
if last 5 years, 3 years, 2 years, 1 year perspective से the highest return देते हैं, तो we tend to choose them, right? Now, is that approach correct, or what should be the ideal approach? How one need to really evaluate a mutual fund? Suppose talk about large cap. There are so many large cap funds are there. So, how do you think is the right approach to choose the right kind of mutual funds?
I feel it's like I won't bet on a car. Actually, I would bet on a driver. To make it simple, कि mutual fund की past returns हाँ लोग देखते हैं. I think वो I feel because there's not much of awareness. That is why people tend to only look at those returns. But उसको जो main person who's driving the entire thing is the fund manager. So
Right.
he is the key force because I feel a fund manager, if he's good, no matter what the market situations, वो गाड़ी पार करवा ही देंगे. So that is something that I really advise everyone that you should really look into the fund manager before investing into the mutual fund for sure.
Right, that is very true. And especially looking at the experience of fund manager, I feel that is very critical. People just focus on again returns and the expense ratio and all. But I feel there is many more things beyond that. I feel expense ratio is still, I mean, it's a criteria, but it actually depends on the fund manager itself. If the fund manager experience, I think he demands a higher expense ratio, and I would be more than happy to pay it.
Wonderful. So when you're talking about experience of the fund manager, in fact, I'm so happy to introduce, Swati Kulkarni. When you talk about experience, she have got decades of experience in the financial market, and that too with one of the oldest mutual fund in the country, UTI AMC. She has been managing Mastershare, that large cap fund, and in fact, she is by qualification chartered CFA from US. She has a professional experience of 3 decades, mostly with UTI AMC. She has been managing equity funds since 2004. Earlier, she spent 6 years from 1998 in analyzing companies across sectors, recommending investment ideas, assisting fund managers in portfolio constructions. She joined UTI in 1992. Around, I think that was a time when Harshad Mehta, most of the Indian people came to the market, actually got aware of
Right.
there is something
Yeah.
called stock market. And most importantly, that was the time she joined UTI. At present, Swati manages a total asset worth 15,000 crores under UTI mutual funds, large cap fund, UTI Mastershare, dividend yield fund, MNC funds, and funds that has been awarded for the superior performance at various points during her tenure as a fund manager. So, Swati, it's a great pleasure and it's a great privilege for all of us to hear from you directly. And please welcome to the show.
Thank you, Neeraj, and thanks all the viewers for joining in today.
Thank you so much, ma'am. And also, I have great privilege introducing Mr. Karthik Raj Lakshmanan, who joined UTI in 2022 as a new fund manager for UTI Mastershare. In fact, Swati ma'am will be retiring soon. So in her place, Mr. Karthik Raj will be joining. He is a senior vice president and fund manager, equity at UTI AMC Ltd. He is a chartered accountant and postgraduate by qualifications, and he worked with ICICI Bank, Goldman Sachs, ICICI Prudential AMCs in the past. So welcome, Mr. Karthik Raj. It's a glad to have you here in our show.
Thank you. Thanks for having me as well.
Thank you. So, ma'am, in fact, I have got so many questions to ask you because you have been in the market and you have seen so many things, so many different cycles that you have seen, right? Right from the time when people used to trade in a ring kind of thing, in an era when the things are completely different from today. Probably people today who have joined the market, they can't even imagine how the market was, 20, 30 years back. In fact, at some point of time, I remember in 90s, people used to say that technologically, from a compliance perspective, Indian market is 50 years behind the European market. And today, we are so proud to say that the Indian market is one of the best market in the world, most advanced markets in the world, man. So, as a fund manager, what's your experience? Would you like to share your experience? How the whole stock market has evolved over these decades, and your experience in last 3 decades? Would you like to share your experience, ma'am?
Yeah, sure, Neeraj. Actually, as you rightly pointed out, our markets have really seen a lot of satisfaction, sophistication, rather. When you talk about, derivatives trade today, the way FNO has taken up, that has replaced Badla trading. We have now almost all the securities are dematerialized. Those were the days when you had physical share certificates, and the transfer used to happen as many as times the shares change hands. So typically the data disclosures has gone up. You have seen that the depth of the market has gone up. There are a lot of institutional participation is there, and the manipulation and the individual influences on the markets, as the depth has increased, that those have been the cases of past. So today our markets definitely command a lot more, as you said, sophistication and modernization, and therefore I think the attraction to the foreign investors also, as India as a well managed markets, well regulated markets, that also is seen in terms of the increasing contribution or increasing interest from various players across the world. So
Right.
I would agree with you. And, talking about fund management per se, we have been at UTI, we've been always the proponents of style purity. We have seen that the regulations also have evolved. Like earlier, large cap category, anything above 65% and more in top 100 was classified as a large cap. Today, after categorization, we know that the comparison is apple to apple. We have more than 80% is invested in top 100 is classified as large cap. And we are going to discuss UTI Mastershare, which is a large cap fund, which was always managed for last 15-20 years before even categorization happened as a large cap. Today's world, we need to be more dedicated or alert about picking up the right information. There is an information avalanche today. There's so much of information around, and we need to separate the noise from the relevant information versus what it was earlier. There was a dearth of information earlier. The disclosures were not good. So I guess we have, you use the right word. We have actually seen a large evolution of capital markets as far as last 3 decades are concerned.
Absolutely, ma'am. In fact, when you talk about Mastershare, it is the first diversified equity-oriented mutual fund that was launched in India way back in 1986. It's been approximately 35 years, right? Definitely, again, support. What is the secret of this consistent performance? You have been performing consistently this fund, and over different market cycles. You have seen 2008, 2004. I still remember that 17th May 2004, that election result day. And before that also, you have seen Ketan Parikh time, all different big market cycles. So across those cycles, how you have managed to maintain that consistency when it comes to your fund, ma'am?
Yeah, sure, Neeraj. So just a piece of information. I started managing this fund from December 2006. As you can see in this chart, there have been various instances where you were earlier talking about bull and bear phases. So those phases on this chart looks very small because we are looking at a long 36 years journey. But individually, believe me, those phases when the markets corrected 20-30% at a time were equally looking quite depressing for some investors. And the questions that today our investors ask about whether after investing my investment the markets fall, what will happen. So here is a live example of what your investments can do wonders for you if you have time on your side. For example, for Mastershare, actually, as you said, it was in 1986 this fund came in. It became open-ended only in 2003. But you have seen that over the years, it has generated 10 lakhs invested, has generated 18.2 crore, almost 6 crore more than the index fund or the index comparison, if you make. So, as 1.5% or 1.3% extra return since inception does a wonder as far as the amount of wealth, extra wealth that it can generate. So that's the beauty of the compounding and the mathematics behind it. Return is an outcome which is not in investor's hand, but time is with the investor, and with time you can beautifully compound your investments. That's what we have seen. And if you ask me how we held our nerve, is basically looking at the convictions that we have and staying with the convictions, also reviewing if there are certain, and Karthik is going to explain the style. We have been always looking at strong competitive advantages when we look for investment into companies. And if we see that there are evidences of competitive advantages weakening, we have taken those corrective steps at times. So I think investment is a team function and there is a team behind it. I was just face to it, taking decisions based on the support and the investment process that I'm sure in the discussion we will have opportunity to talk about it.
Great. In fact, my next question is for Mr. Karthik. How do you feel taking over as a fund manager for such a fund which has such a long history and a rich history? So how do you feel taking over as a fund manager for this fund?
Sure, Neeraj. I mean, it's definitely a privilege. I mean, like ma'am just mentioned, 36 years old fund, the oldest fund in the country. It's a real privilege to manage a fund which is outperformed the benchmark. Ma'am has managed this fund for the last 16 odd years and outperformed the benchmark. So it's a great history, and looking forward to continue with that with the support of the team.
Wonderful. In fact, our viewers would like to definitely hear much about or know much about how the fund is being managed, what is the philosophy, what is the style, the strategy, and all. So if you can present, make us understand the whole product, that will be great, Karthik.
Yeah, so Mastershare is a large cap category where at least 80% of the corpus has to be invested in the top 100 companies by market capitalization. Typically, Mastershare has had about 80 to 85 odd percent in the large caps. We still have a headroom of about 12 to 15 odd percent to be invested in mid and small cap companies where we find superior return generation opportunities or alpha opportunities. We have enough guardrails in the company, in the system for each of the funds in terms of the maximum overweight that we can have, the fund can have in a particular sector, and maximum exposure that we can have in a sector, maximum stock exposure, the top 10 concentration, and so on, so that the risk parameters are met, and that's monitored continuous basis. Coming to the philosophy at UTI, the investment process and philosophy, we call it as score alpha. The process, we try to screen all the companies on two parameters, that is return on capital employed and the operating cash flows. it's a three-tier system, rating system, where the companies are rated R1, R2, R3 basis the return ratios, and C1, C2, C3 basis the cash flows, last 5 years cash flows and return ratios. And each of the fund has a particular style. Mastershare is a GARP-oriented fund which focuses on growth-oriented companies at reasonable valuations. That is, growth at reasonable price, GARP. And at the same time, we have a little bit of opportunities on turnaround or value stories. So it's growth as well as a little bit blend of value strategies. In terms of the other unique positioning of Mastershare, it is focused on companies which have competitive advantage, which ma'am just touched upon. We look at companies which have strong competitive advantage or moat. That is, it could be in by way of tangibles or intangibles. Tangibles, like, I mean, we could have a cost competitiveness, distribution network, a cheaper cost of funds, and so on. Or intangibles like a strong brand, the R&D capabilities, or patents, and so on. These competitive advantages provide a longer runway for growth for the companies, and visibility for us in terms of earnings and earnings growth as investors or minority shareholders. As long as the competitive advantage is sustained, we continue to hold on to them. And if we see the competitive advantage weakening, we generally exit those companies. So that's the portfolio kind of construct. Mastershare stands for a growth at reasonable price and identifying competitive franchises. Like I mentioned, the fund has around 85 odd percent in large caps, but at the same time we have about 12 to 15 odd percent in mid and small caps. So these companies, yeah, these companies are the non-100 companies, but at the same time, they could have sector leadership. They could be present in a small category and they could be the leader in that category, or they could be having a faster growth than the industry, or they could be seeing a turnaround as far as the company is concerned. So even the mid and small caps, the unique positions that we have here on the right hand side of the slide, these names also we own from a longer term perspective, and some of them could eventually be large caps as well. So we have a blend of bottom up ideas as well as the top 100 companies. And if you see the positioning as of now, the right hand side shows the top 5 companies, and the top 5 active weights, and the top 5 absolute weights. And the left hand side, we have the sectoral weights, and vis-a-vis the benchmark, that is the active weight. So we are overweight on the private banks within the financial services. That is our largest sector. There we believe that the credit growth is likely to be higher. They're continuing to gain market share. The asset quality is at its best in the last probably 2 decades. And valuations compared to even last 5-10 years is not moved up as a pack. So that is one of our key overweights. Other than that, we are overweight on auto and auto components. Gone through a rough patch in the last 3-4 years, and most of these headwinds seem to be kind of coming down. And the longer runway for growth still remains, because the penetration, whether it is in four-wheelers or two-wheelers, is still quite low. So to that extent, you have a longer runway for growth, and cyclically also the sector is kind of turning around. Besides that, within the consumer pack, we are more overweight on the consumer durables and retail, where again the growth is much better, while we are underweight on FMCG, where the growth has been a little lagging. And we are overweight on the telecom and the capital goods or the industrial space, while we are underweight on energy, we are underweight on power utilities and metals, and we are kind of neutralish on IT. IT is something where we are seeing a little bit of slowdown in growth because of the global macros, but at the same time, these are companies which have generated huge cash flows, and probably at when the valuations kind of correct, we would be happy to relook at them in terms of increasing the exposure.
Great.
Yeah, Neeraj. Yes.
Yeah, yeah. Thank you so much. In fact, Karthik, we have got Aditya and Harsh. They are young entrepreneur, educator. They have been doing lot many things, lot many training programs. Uh, they are also here us with us today. So in fact, I would like to invite both of them. And Aditya, Harsh, if you have got some questions, you can go ahead and ask both Swati ma'am and Karthik. Any questions that you have, go ahead.
Definitely, we are very much looking forward to it. Okay, first of all, Swati ma'am, Karthik Raj sir, it's a complete pleasure to be with you. We were discussing this with our father, and he has had a history with UTI market share. In 90s, he was actually an investor in the UTI market share. Unfortunately, there was some financial condition that he had to sell it off, and till date, it's one of his biggest secrets. So this mutual fund has got a lot of history with us, and we are very very excited to start.
Yeah,
on the question.
it's a privilege. It's a privilege.
Okay, Swati ma'am, now we were seeing that most of the mutual funds find it a challenge to beat the index, whereas UTI market share since inception has done it very successfully. So, what is UTI market share doing differently than other mutual funds?
I think I'll just take. Why there is echo? I'll just take you to the this question about what is different as far as UTI Mastershare is concerned. Um, one is, of course, Karthik described how we are looking at competitive franchise. And when we look at competitive franchise, it is important for us to actually just not look at the winning ideas, but also to avoid equally important for us as a part of the process. So I think that is one differentiating factor which is reflected in our holding period for the companies with strong competitive franchise. Our holding could be in past, like last 15, 20 years, some of the names would still be there in the portfolio. There are some names which are there for 5 years. So I think all this is reflected into low portfolio turn. If you see amongst large caps, UTI Mastershare would be at the lower end as far as the portfolio churn is concerned. So we like to keep our conviction where there are signs of companies either gaining market share with their financial strength, or in terms of the way that they have been able to gain and keep supporting the brands, be it in terms of the distribution strength or the various factors that Karthik just described. And here is the slide where, whenever the markets have corrected, I think this is also a differentiating factor, that Mastershare's NAV has corrected less than the market correction. You can see this in the column 4, where, for example, in Jan 2004 to May 2004, when markets corrected by 28%, markets Mastershare's NAV fell only by 20%, generating 8% downside alpha. And this probably for new investors, it would be interesting to know that the people who endure this kind of falls, they ended up with much better gain over the next 3 years and 5 years, which is reflected in the last two columns on the right hand side. So I think that is also a differentiating factor as far as the performance of the fund is concerned.
Very interesting. Very interesting.
So I want to ask the next question. So this is something which I am also thinking about. So when we go back to the 2008 time when we had a great crash, so at that point of time, the American markets were slipping down while the Indian markets were going up. And I see that we're in the exact same situation right now. And American markets are coming down while Indian markets are still recovering, and I feel they're still pretty all right. So do you think we are in the same situation as that, or is it something different?
Yeah, right. In the last 1 year or so, if you see clearly, Indian markets have outperformed both the emerging markets as well as developed markets.
Right.
Clearly, that shows the strength. From a macro perspective, we are in a much better shape compared to, say, even 2013-14 when the US Fed tapering was starting. Whether it is in terms of the forex reserves or whether it is in terms of current account deficit, we are still under a much better position today compared to 2013-14. And while the currency has depreciated against US dollar, against most other currencies, it is held up very well. So even there, it is outperformed compared to many other markets. From an economy perspective, it is still amongst the large economies, it's still the fastest growing. Uh, we've seen a good recovery after COVID. And in fact, one of the fastest and better recoveries compared to many other economies. And this, we believe, will likely continue going forward as well. In terms of the capex, the government capex is continuing, and private capex is also happening in a few sectors. So while it may not be a very strong capex cycle, but we definitely see a good recovery on the capex side as well. So we seem to be in much better position. But at the same time, we do depend on foreign capital, and in the short term, the flows could kind of determine the market direction. So it's not a complete case of decoupling. And also to the extent that we have export services, especially IT, which is dependent on the global economy, there is some linkage, and if at all there is a significant slowdown there, that could have a bearing on our country. But overall, we seem to be in a much better position, and the growth seems to be amongst the highest within the large economies.
Right. Makes sense. Thank you.
Very interesting. So another question is that when we were seeing the breakup of UTI market share, 32% is in financial services, which is the most considerable amount. Then IT, then automobile, then FMCG, healthcare. Sir, where in the coming 10 years, where do you see can be one of the most aggressive sectors that would see growth?
Yeah, clearly we see, like you mentioned about the demographic dividends, that is definitely an opportunity. So the per capita income is about 2,000 odd dollars, around 2,200 odd dollars, and that is rising. And like you clearly highlighted, the dependency ratio is coming down. So the disposable income is definitely on the rise. And to that extent, there is opportunity on the discretionary consumption side, and definitely financial services also, there is a huge scope because there is under penetration there as well. And we have pockets of opportunities even on the capex side, and we could be exporting in, and that export opportunity could be there in quite a few industrial pockets as well. IT, anyways, is something which has been consistent delivery over the last 2 decades. Again, that's also a pocket of opportunity. So, from a longer term perspective, there are quite a few pockets. We need to keep on evaluating which is the one which is growing faster, and from a market perspective, how the valuations are stacking up versus the growth, earnings growth, and the cash flow growth that these sectors can deliver.
Yeah, just to add, actually, there are certain structural changes that we see post GST. There is definitely a move towards an organized, or from an unorganized formalization of economy, the urbanization which is likely to go up. So all these are good catalyst for the businesses which are already having leadership in the respective sectors, and therefore we think that through Mastershare, which is a large cap fund, people could ride to take on those opportunities which could come up. Well, again, there will be a lot of new businesses which are coming. India is known as a startup capital for the world. So we will both have the established business doing well on certain themes. or certain structural changes that we are likely to see in the economy on the basis of the demographic dividend which you talked about. And again, there are new businesses which could keep coming to the markets, and the listed universe could expand. So there will be a lot of opportunities, and we are in an exciting phase, I would say.
Ma'am, this is very interesting. Now, I feel UTI market share is a mutual fund holding legacy, right? And Karthik Raj sir, in the coming future, you would be handling the reins of it. How, as a fund manager, I want to know that so many people, so many youngsters aspire to be a fund manager, and you're going to be in such an important situation. What would be your advice to them, and what are your plans specifically taking this mutual fund forward?
So Harsh, before Karthik addresses this, it is Master Share, not market share. The fund name is UTI Master Share.
Master share, yes.
Yeah, Karthik.
Yeah. Right. So just, I mean, from the fund perspective, clearly we have defined positioning for each of the funds. So Master Share stands for a growth at reasonable price. It stands for the competitive advantage franchises, a large cap fund. So those metrics really don't change. So that is something that will continue. The team looks at it from that way. We have a very strong team which clearly works on the processes, and we keep on further improvising the process and philosophy that we have at UTI. So there's not really going to be much of a change there. Uh, from investor perspective, clearly, like ma'am said, it is exciting times from a longer term perspective. There is clear opportunities. India is going to be one of the highest growth economies, and to that extent, there is going to be opportunities. One needs to kind of stay invested, and that could provide good compounding opportunities from a wealth creation perspective.
Compounding opportunities, very true, sir, very true.
And in fact, okay, I have got few questions from our viewers. In fact, quite a few questions. मैं viewers को भी request करूंगा कि अगर आपका पास कोई भी questions है, पूछना चाहते हो, please feel free, go ahead, type in your chat box, and we'll be so happy. Swati ma'am and Karthik sir will be very happy to answer those questions. So again, हर्ष आदित्य, आप दोनों के लिए आई थिंक थोड़ा वहाँ पे कनेक्शंस टूट गया है. तो मिस्टर शिव शंकर वैष्णव ने पूछा है कि किसी म्यूचुअल फंड में किसी म्यूचुअल फंड मैनेजर कितना महत्व रखता है इन ए म्यूचुअल फंड परफॉर्मेंस में. हाउ इम्पोर्टेंट इज द रोल ऑफ ए म्यूचुअल फंड मैनेजर इन द परफॉर्मेंस ऑफ द म्यूचुअल फंड इटसेल्फ?
I feel Karthik Raj and Swati ma'am would be in a much better position to answer. But for
Yes.
us, it's not the car, it's the person who's handling that machine that matters. So fund manager plays the most important.
Right.
Yeah, so
And yes.
Karthik, you would like to talk on this behavior versus this?
Right.
Yeah.
Yeah, no, so clearly what we've seen and through our learning process, what we've identified is that as long as you stick to a process and continue through that over a longer period of time, you can deliver returns. In the markets are going to be volatile at all points in time. You will have some event or the other because of which the markets keep on moving up or down. So there is likely to be volatility. For example, 2020 March, very recent phenomena, you clearly saw the markets going down by almost 40%. A faint-hearted investor would have kind of said, I don't want to further erode capital, and to that extent,
Right.
if that person had been gone, then they would have lost the opportunity to kind of participate in the upside which we saw in the next couple of years. So staying invested is something which is more of a behavior that is very much required from the investor perspective. From a fund manager perspective, the entire team together come up with a philosophy, a process, and we stick to that process through the thick and thin. That ensures that we are able to generate good returns. So this chart, if you see here, shows the rolling returns on a 1 year, 3 year, 5 year, 10-year basis. Clearly, as we increase the time horizon, as the investor increases the time horizon, the chances of making positive returns have increased manifold. Here, if you see, we are showing the instances where the returns have been negative. On a 1 year, we have had 22% of instances where the master share returns have been kind of negative. For the last 15, this data is for the last 15 years, but on a rolling basis, 1 year, there is a probability of 22% negative returns. But that comes down to almost 2% when the time frame is 3 years for the investor. And if we move to 5 years or 10 years, there is almost a very high likelihood the returns are going to be positive. And almost 80+% of times in 5 year horizons, the returns have been better than 8%. That is to say, even compared to the fixed income, the returns have been better.
What a
And
strong
10
fund,
years, this number is as high as 92 odd percent. Yeah.
Yeah.
So just wanted to say that the investors need to kind of keep a longer horizon. Markets are going to be volatile. That is the nature of market. If you take a longer term view, fundamental investing and longer term view, it has delivered returns.
Right. So I would like to ask one thing. Yeah, please,
Uh,
please.
Harsh, just to add what Karthik has been saying, the greed and fear is a human behavioral traits, and that is what needs to be controlled by making time as your friend, and that's what we wanted
time
to
as
show
well.
when we shared those numbers.
Very true, ma'am.
All right. So I want to ask one thing because this is something which I am very curious on. So we'll go back to the times of Harshad Mehta or Ketan Parekh. So I'm sure that throughout the fund, you probably might be having some holding on ACC or any K10 shares. So at that point of time, how do you manage the fund in those crises?
See, first of all, actually, I took over in December 2006, so I wouldn't know what were the holdings in 90s. But, I can vouch for the investment process. And we would rather go by, as Karthik was describing, the growth at reasonable price as a principle. But there is a lot of, internal assessment goes as far as what has been the past trend for companies as far as the return on capital employed is concerned. Is there any chance, if you're looking in a cyclical sectors, is there any chance that the cycle turns for good and the company has strong advantages to its side to come out of this cycle much stronger with much better results? And if there is an increase in earnings, typically we have seen in past that your return ratios improve as well as your re-rating also happens, so the return outcome could be much larger for the investor. So we take much I would say a comprehensive assessment of fundamentals of the company. And being a large cap space, always there is a advantage of good management bandwidth are given perhaps, but what is important is that whether the company has those advantages which could be durable, and therefore those are wide modes. So I think more than certain momentum which could be backed by whatever narrative you give in the hindsight. Yeah, over back to you.
Very interesting. Very interesting.
Right, right.
Okay.
Thank you.
Okay. I got a small question for Mr. Karthik. So how long do you think the rate hike cycle is going to continue? Are you coming towards an end of this cycle? So when can we expect that?
Yeah, here we are going by the Fed. Clearly, it seems they will continue. The real issue for them is to bring down the inflation. So, as long as the inflation continues to be high, the rate hikes could continue. And the interest rate differential between India and US is kind of at a lower level. And to that extent, maybe, there is some room for further rate hikes here. From our own domestic economy perspective, the inflation seems to be little manageable levels, considering our history, we've seen much higher inflation. I believe we are in a much better situation. Very difficult to call exactly how many more rate hikes we will have, but far better in control compared to even some of the developed.
Yeah. And okay, again, a question from our participants. Again, once the rate hike cycle ends, like quantitative easing starts, right? Which are the sectors probably, again, it's a general investment, perspective. Which are the sectors they're likely to perform better than the other sectors once that whole expansion phase starts once again?
Yeah, again, not sure whether it will play out the same way as we are hoping that it follows up with a quantitative easing, because in the system over the last 14, 15 years, ever since the GFC crisis, we've seen a lot of liquidity from a global system perspective. Not sure whether there will be further more. But clearly, like we discussed, it is far more bottom up. There could be individual companies which are focusing on gaining market share, which are focusing on growing their business even in a tough environment. Those are the companies which actually come out much better when the economy starts to improve. So that's what we've seen over cycles, that rather than trying to time what will work during that short period of recovery, companies which have strong competitive advantages actually turn out to be winners over a longer period of time. And clearly, equity investing is long term. I mean, at least 3 years, if not 5 or 10 years. A much longer horizon is required. So, to that extent, it is far better to look at better businesses which are gaining market share or holding on their turf even during a tough downturn. Those are the companies which actually kind of outperform.
Over to Harsh, Aditya.
So this is a very personal question. Is that when you do your entire analysis and you decide that we want this allocation, that allocation, and whatever parameters. So, ma'am, suppose if you are choosing that on a personal investment basis, would your analysis be the same as the analysis of being a or being in a role of fund manager? And if it is different, how and what prospects would you have different?
So actually, I would just like to talk about when it comes to a retail investor. The basic difference is that here we have a fair amount of team approach, an institutionalized approach. So when it comes to, let's say, first of all, as a fund manager, we cannot invest directly in the equity markets. So our investments are through our funds only. So therefore, I think we will also, like retail investor, will have to go as far as the individual asset allocation is concerned. What are the financial goals and how we can fulfill those financial goals, first of all. Secondly, the kind of professional approach as the institutional investing would give us. I think the retail investors perhaps will not be able to, even they have expertise, they will not be able to have that much time and that much bandwidth to kind of look at different sectors in a singularly. So therefore, I would say that one has to look at mutual fund as one of core investment and wealth generating vehicle than, let's say, going on their own solo. So I definitely would advocate that some portion doing 10-20% of your portfolio to satisfy your intellectual prowess. One can look at directly investing, but I think I would still go by this. And again, this chart which suggests it will be very difficult for retail investor to control greed and fear.
Yes,
We
ma'am.
have seen investors taking steps to either book profit very early, not allowing your investments to compound and fructify, not allowing them to give time, or not investing with the fear of further fall in the market or further likely to time it better. Whereas when it comes to fund manager, we are not taking that cash call. We look at staying invested for a long term, and that reflects in our cash position as well as the returns that we talk about versus the individual investors' experiences.
So true,
And
ma'am.
actually, if you could just allow us, we can show you that even in large caps, there have been instances where companies have generated multi-bagger returns. So you don't have to really look for those ideas into small cap and, to really get those multi-bagger returns. There are cases where we have seen over 17 years, this chart reflects there are companies with strong competitive advantages have generated more than 15% CAGR return. And again, some of the young viewers today, they might be thinking that that's a very long period, 17 years period. Look at what has been the performance over last 5 years. So, all these opportunities are there in the market, but then it is not that all blue chip companies will give you these returns. There are also value destructors within the large caps, which a process is needed to weed out these early enough. So that's what actually we wanted to highlight also today, and your question gave us that opportunity.
Ma'am, I completely agree because, as you mentioned, investing on paper and on reality is very different because the emotional biases come in. And I think that is why going through a mutual fund that has been a performer can be one of the best options out there. Yeah, this was very interesting. Thank you so much.
Great. In fact, we had a wonderful session. We have almost coming to an end of this program today, and it's a great privilege, opportunity that we have spoken to both of you. So, what's your final words to the retail investors? Of course, Indian market, Indian economy is again in a very, very poised in such a way that it seems lots of opportunities are there in the coming years. So, how do you suggest? What is your advice to retail investors? In fact, I'd like to hear from all four of you, starting with Mr. Karthik.
Yeah, Neeraj, thanks. I'll just share this slide where we've shown the long-term performance of large cap versus mid and small cap. So clearly, what we wanted to highlight is that, like ma'am said, the first requirement is that the investor should have equity allocation, and within equity allocation, large cap as a category should be core part of the portfolio. Is something that we believe. What we've seen over a last 17-year period is that if we take the indices, the large cap indices index and the mid and small cap index, what we've seen is that the large cap returns have been almost in line with the small cap index return, and is slightly lower than mid cap over a period of 17 odd years. But there have been many pockets when the large cap has actually outperformed. And also the point that if you can see in the graph itself, the volatility in large caps have been far lower compared to mid and small cap. So on a risk adjusted basis, actually large caps have fared quite well. And it is required that new investor definitely has some allocation, core allocation into large caps as a category. And the message for the investors is stay invested from a longer term perspective. Valuations could be expensive at this point in time, but as we move for a longer term horizon, the compounding clearly takes over and wealth creation happens. That's what we've seen in the last 2-3 decades, and we believe that the growth outlook for India is good, and to that extent, it should be repeated.
Yeah, ma'am.
Yeah, I would just like to add one thing, in the in respect of return expectation, because we often see the past returns, but remember that in past the risk-free rate itself was very high. Today we are talking about 7 to 8% as our risk-free rate, and equity investment should demand about a risk premium over and above that of about 5% to 6%. So the return expectation from here on should be 12 to 13%, and that itself would be inflation beating and other asset class beating return. So one should not have a very high expectation. If you happen to come at the lower levels of valuation, well, you could have a much better return. But I think overall, if you enter into a reasonable valuation zone, your return expectation from equity should be 12 to 13%. And if you want to consider having a good retirement corpus as well as having a continuing in standard of living, equity allocation has to be there. I would add that. Yes.
Great. Harsh, Aditya, over to you.
My only thing would be that stock market looks very glamorous from outside. I think it's made to be that way. But in reality, just in continuation of Swati ma'am, is that what investments pan out to be on paper and in reality for you is very, very different. So if you're a young investor, be smart about it and be sure you can take the benefit of compounding via good mutual funds. UTI Mastershare being number one in that. And I hope you take the full benefit of your age.
And in the last couple of years, there's so many people who have now been fully researching in stock markets. I would just tell them that make sure to put 50% of your, let's say, funds in 50% of your portfolio in a fund, and not just buy individual stocks out of the full 100% portfolio of equity portfolio you have, because in long term you'll see that it's always best to be benchmarked to a fund. So it's best to put 50% fund, and 50% you can actually try to do different things, but at least 50% should be parked with a good fund.
Great, wonderful. In fact, thank you all of you. It's a great pleasure talking to Swati ma'am, Mr. Karthik, and Harsh and Aditya. It's a wonderful thing, wonderful time that we had. I'm sure all our viewers, they have learned a lot. They have taken lots of learnings from this session. With that, I'd like to thank all the participants and all our panel members. Thank you so much.
Thank you.
Thank you.
Neeraj.
Thanks,
Thanks,
Neeraj.
Harsh, Aditya.
Thanks,
Thank you.
And
Thank you
thanks
so
to the
much.
viewers.
Thank
Thank
you.
you.